Welcome to This Explainer. Okay, today we are diving into the absolute roller coaster that is Syndax Pharmaceuticals. If you follow the biotech space, you know that getting a first-in-class cancer drug across the finish line is a massive, massive deal. But what happens the day after the FDA pops the champagne? How does a company balance explosive revenue growth with scary clinical side effects, fierce competition, and a pretty wild cash burn? Well, let's jump right in and find out. Here's our roadmap for today. We'll start with a quick snapshot of Syndax, look at their recent commercial triumphs, explore the melanin inhibitor battlefield, check out some clinical risks, dive into how they're financing all this, and wrap up with a massive debate over proxy dilution. All right, part one, the Syndax snapshot. It's a true biotech balancing act. To put things into perspective, Syndax is sitting on a market cap of over $1.56 billion. And over the last 52 weeks, this stock has been on a wild ride, bouncing from a low of around $8.50 all the way up to almost $26. But here's the really crazy part. They recently saw a massive, and I mean massive, spike in options trading. Call option volume jumped 254% above average. So, the market is definitely bracing for something big here. Moving on to Section 2, Commercial Triumphs and Revenue Surge. Let's look at the true cost of all this growth. Check out this number. In their Q1 2026 earnings, Syndax posted an explosive 224% year-over-year revenue surge. They brought in almost $65 million for just that one quarter. That is a huge top-line win, fueled right by their pivot into a fully fledged commercial company. But, and it's a big but, that kind of growth is not cheap. While their earnings per share actually beat Wall Street's expectations at negative 48 cents, just look at that net margin, negative 111.88%. Ouch, why are they burning through cash like that? Well, Syndax is trying to launch two different drugs at the exact same time, Revuforj and Niktimvo. Building out global sales and medical teams from scratch for not one but two complex oncology drugs? Yeah, that is literally going to cost you. Section 3. The menin inhibitor battlefield. This is where we get into targeting specific leukemia subsets. So their crown jewel is a drug called revumenib, which goes by the brand name Revuforj. Basically, it's an oral, highly selective small molecule inhibitor. To put that in plain English, it targets and literally breaks the connection between two specific proteins. When that connection breaks, it shuts off the genes that are driving the leukemia. It's a huge breakthrough, and it actually got FDA accelerated approval for a very specific group of acute leukemia patients, even kids as young as 1 year old, who frankly just haven't had effective treatments before. Now, Syndax isn't the only player in town. The market for these menin inhibitors is basically carved up into different genetic battlefields. Syndax is dominating the KMTA subset. But on the other side, you've got Kura Oncology, who just got the nod for a drug targeting a totally different but complementary NPM1 mutant subset. So instead of a brutal head-to-head cage match for the exact same patients right out of the gate, they've kind of split the map based on specific genetic mutations. Which brings us to Section 4, Clinical Risks and Safety. Specifically, managing something called QTc prolongation. Breakthrough science always comes with hurdles, right? Take this recent medical case study. We've got a 76-year-old patient with relapsed leukemia taking revumenib basically as a last resort. Right around day 64, things get scary. He develops a severe disruption in his heart's electrical system, a life-threatening arrhythmia. But the clinical team didn't just throw in the towel. They paused the drug, placed a permanent pacemaker, aggressively pumped in IV magnesium to manage his electrolytes, and incredibly, they were able to safely restart the cancer therapy for another 29 days before his leukemia naturally progressed. As this quote from the Oxner Journal points out, the standard playbook usually says you just stop the drug entirely when these severe arrhythmias pop up. But when you're balancing the risk of a heart issue against a terminal leukemia diagnosis, you have to get hyper-individualized with patient care. The big takeaway here? Doctors are figuring out in real time how to safely manage these extreme side effects, which is absolutely crucial for keeping patients on these life-saving and, let's be honest, revenue-generating therapies. All right, Section 5, Financing the Future. How exactly do you fund this massive commercial phase? As you can imagine, navigating those clinical minefields and building a global sales team requires a mountain of cash. So, to fund this super aggressive commercialization strategy, Syndax went out and issued $250 million in convertible senior notes. Basically, debt that comes due in 2031 with a really low interest rate of just 2.25%. The mechanics of this debt are actually super interesting. It comes with an initial conversion price of about $24.76 a share. That is a very confident 35% premium over where the stock was trading when they announced it. So think about it. The investors buying this debt are essentially placing a massive bet that Syndax's stock is going to completely smash past that $24 mark by 2031, which would let them convert that debt into some seriously profitable equity. Finally, Section 6, the proxy dilution debate. It's ISS versus Syndax. But debt isn't the only way they pay the bills. Biotech runs on specialized talent, and to get that talent, you need to hand out stock options. Well, this sparked a major proxy fight. A huge advisory firm called Institutional Shareholder Services, or ISS, literally told shareholders to vote against Syndax's new 2026 equity incentive plan. ISS argued that giving out all these millions of shares was just way too dilutive for the current shareholders. Well, Syndax wasn't just going to take that lying down. They immediately clapped back with an SEC filing saying ISS completely botched the math. See, ISS calculated a massive 35.5% potential dilution, but Syndax pointed out that ISS conveniently ignored 5.1 million leftover shares from an old expired plan that were permanently canceled. When you crunch the real numbers, Syndax says the actual dilution is much lower, closer to 28%. And there's a really good reason Syndax is fighting tooth and nail over this. Like the CEO said, if they can't offer competitive equity packages, they just won't be able to attract top-tier talent. It's that simple. They are going head-to-head with absolute pharma giants who have incredibly deep pockets to hire the brightest minds in oncology. To save their actual cash reserves, they absolutely have to use stock to pay their people. So looking at the whole picture, we're left with this one big, critical question. Can Syndax's incredible commercial momentum actually outpace the heavy costs of its clinical hurdles and financial juggling? I mean, they've got the groundbreaking science, they've got the FDA approvals, and they're staring down triple-digit revenue growth. But dodging cardiac risks, fighting off competitors, and keeping top talent happy without drowning their shareholders in dilution, that is going to be the ultimate test. So what do you think? Is the high risk worth the potential reward here? That's all for today's Explainer. Keep analyzing, and we'll see you next time.